securities lawyer. I practiced here in Austin for about 15 years, and I grew up here in Austin as well. I didn't go to law school here. I went to SMU in Dallas. They didn't want me here, but came back here as soon as I could. And so when I say that I'm a securities lawyer, you have to think about what a security is, and it's obviously a share of stock. You know, you go buy Microsoft or Apple, that is a security. But a security also is an interest in a limited partnership or an interest in a limited liability company. And so that's what I deal with all the time. I'm helping people come in, and I help people, you know, whatever it is, whenever you have a business, there are reasons why you want to incorporate, and probably something that you guys talk about in some of your seminars, but it protects yourself from liability. Your risk is whatever you put into the company that you form. So whatever it is, whether you have a real estate investment, a restaurant, you know, a software company, anything, you know, that's the whole purpose of incorporating, is that you can go out and enter into contracts with people, and they sue you, but they sue your company and not you. And if you do it correctly, and I can help you do that, of course. But what you are, you own that company, and you own securities in that company. If you're a single owner, the sole owner of the company, you're 100% owner of that company. All the securities you own. And so that's what I do. But you know, I come to a group like this, and I try to put myself in your shoes and like try to convey information that I think would be useful to you. And so this group I know is comprised of real estate investors, people that are interested in investing in real estate. And you may go out and you may go do these deals that Phil and Shenoah were talking about before in your own name, and that's fine. There's no real downside to that, but the risk is that if something goes sideways, the person that's injured, whoever that would be, they can sue you. And again, this goes back to the reason why you would maybe form an entity, a business entity, to conduct your business operations through your investing. You would title your real estate in the name of the company rather than in your own name. And so, you know, there are reasons, liability protection reasons, that are bona fide, really good reasons for incorporating. But then also, you may want to partner with somebody. I don't have, like some of the examples, I don't have the cash, but I found the deal, but my friend has the cash. And so he's going to give it to me, and then I'm going to enter into some kind of term, some kind of arrangement with him. And it may just be a loan, but loans, you're capped with your interest rate at, you know, it's around 20% here, and it varies, but, you know, that may not be an adequate return to compensate an investor. And you know, if you have an investor that's coming in and buying, you know, investing in you and says, hey, I believe in you, I think that you can really turn this around and make a bunch of money, more money than what I would get just if I loan the money. And I understand there's greater risk associated with that, but there's also a potential greater return for me. So that's an equity investment rather than a debt investment. And so if you can think about that distinction, you know, both are securities, but the equity investment is potentially the higher return, but also higher risk. There are reasons for that, but in any event, so you know, getting back to who you are and what you might be interested in, you're partnering with somebody, or you're going out and you're partnering with several people, and the thing that you have to think about, and I don't know if I can scroll through.
Yes, you can.
Okay.
Can you make one quick announcement?
Oh, sure.
Yeah, can I see Mary Henderson? Is there a Mary Henderson here? Or a Gerald and Claire Hunt?
Okay. So the larger deals that I'm involved with is it's an offering, and a developer's come to me and they bought a piece of property off of South Lamar, and they've got these two lots, and they rezoned the lots, and they're combining the lots, and they're putting up a 40-unit. You know, they're tearing down the houses that are there, and they're putting up a 40-unit condo development, and that they're raising $1 million to do that, and they pay me, you know, some amount of money to put together all their documents for them, a limited partnership agreement, an offering memorandum, you know, and And really what they're doing is they're acknowledging what's up there now, is that when you go out and partner with other people, I may be getting ahead of myself a little bit, but I'm kind of jumping ahead of the instance where it's just like you and me both partnering to buy a property, and we're both involved in the active management of it. You know, I'll paint and you do the floors or whatever arrangement we have, but we're partners, we're actively managing it. But then what I like, where I really make the most money off of it in my practice, is the deals where you're going out and you're syndicating a deal. You're saying, I have knowledge of this deal, and I have 10 friends that are each going to give me $100,000, whatever, you know, add the zeros, subtract the zeros, whatever, however you want to make that realistic in your mind. But you're going out, you're going to your friends, and you're saying, hey, I've got this deal, give me this money, and then at the end of year 1, year 2, year 3, I'm going to give you your money back plus X dollars. And we're not going to do this as a loan, though, because there's this risk associated with it. I don't want to obligate myself like that, you know, to run the risk that you could take the project away from me. But there's such great returns here that, you know, come and be my equity partner. Trust me, I'm going to actively manage this property, develop it, do whatever it is that's necessary to develop this property into an asset that can be sold. The timeline that I'm going to tell you. And at the end of it, we're all going to be happy. You're going to get your money back plus your return. And I've had this great idea, and I did a great job managing it, so I get this return. I get my carry, really. That's what I'm after. So that's the kind of deal that I put together regularly. And it's for real estate, and it's for other types of businesses as well. But really, the most important thing to remember when you're putting together a deal like this is that you're using other people's money. And you know, I was just talking with a good friend and partner before that you know, everything's fine until the deal goes sour, and inevitably you're going to have mistakes. I made a mistake today. You know, I've made mistakes before. I'm going to make mistakes in the future. Inevitably, you know, in this process, you're going to make mistakes, and I've helped clients that have made mistakes and lost all the money that their investors gave them, and in the end, it was they didn't get sued, and it was really because they observed this principle that you have to always remember that you're using somebody else's money, and when you do that, you have to tell them what you're going to use the money for, and you have to continually update them and tell them, you know, this is how it's going. We have a delay in the development project, and so we think that it's going to be another 3 months, whatever. But you're always going back to them, and so that's a lot of what I do. Is I counsel people on the initial disclosure. You know, I say, hey, here's the deal. We're going to put together a disclosure document. I'm going to disclose all the material risks to you that you need to know about to make your investment decision. I'm not going to fail to disclose anything that's material that you would need to know. I'm not going to just hold back the fact that there's a radioactive, you know, dump in the back of the property. I have to tell you that in order for you to have all material information for you to make an investment decision. And if not, the consequences for that are really severe. And what happens in that scenario is going back to the whole reason why you form a company in the first place. With the securities laws, if I go out and I tell you about this great deal that I'm going to buy these 2 houses, tear them down, raise $1 million, put up 40 condos, but I lied to you about that, and really I'm taking it and I'm spending it on whiskey and women, and then, you know, just lose it all and go crazy. Well, you know, I'm operating through my LLC, right? So I don't really have to worry. Well, unfortunately, or for better or worse, the securities laws create personal liability for you. And again, you know, I should really make a distinction here between the type of deals where it's just, you know, me and my friend going out and forming a partnership. We're 50-50 partners. We're doing all the work. I'm paying. He's doing the floors. Whatever arrangement we have, we're both actively engaged in that project versus the scenario like I described before. And so when you're both actively engaged in the process and management of the whatever the business is, it's hard for you to say, hey, I didn't know that we were going to pay the electrical bill this month, or I didn't know that we were going to, you know, buy that granite countertop, put it in, I thought we were going to do Formica or whatever. You know, you're there every day. And so it's hard for you to accuse your partner, hey, I didn't know you were going to use the money that I put into this in that specific way. But when you have, and this is getting back again, it's just the deals that I make money on as an attorney, and the bigger deals, the bigger size deals, and hopefully deals that you guys will be involved with at some point, probably already are, some of you certainly. There's some really sophisticated people in this group, and one of the most sophisticated people challenged me with a question last year, and I wound up, getting to know him better, and we partnered, and it's been a great relationship, and really thankful. But in any event, that's really what I'm talking about tonight, because the deal when you partner up with your buddy, you could fail, but if you fail because your buddy's stolen the money, it's kind of shame on you, because you're there every day. You're working at the house and painting, and he's there doing the floors, and if he writes a check, you should keep tabs on him. But if you've got one of these deals like I talked about, where you've gone out and raised $1 million from 10 of your friends, you've got to be really careful. You've got to tell those investors what's going on with the project, how you're using their money. And if you don't, it might be okay, right? You go out, you do exactly what you think, you tell them that you're going to do, you execute your plan, you do it perfectly, everybody makes money, and everybody goes away happy. And I write documents that usually don't get read. It's sort of sad. I had literary aspirations in high school, and I started writing poetry again. I'm newly single. Over the last 3 years, I got a divorce, unfortunately, but I've never been happier, so it's a good thing. But in any event, I'm a writer, and I write millions of words, or I don't know, I've never counted them, but tons of words that never get read. When they get read, the time that they get read is when the deal's blown up. And so what I have to do is I have to disclose to your investors, make sure that you disclose to your investors, again, going back to this idea of all the material risks that are involved in the project, or not failing to disclose anything where the failure to disclose it is material.